Good evening and welcome to another episode of the weekly market wrap. My name is Daniel Ang, and today, of course, is February the 9th, and we are 3 weeks into Donald Trump's administration, and a lot of things has been happening, as you are probably aware of, and this has caused market to actually gyrate. And today, I'll be covering what happened in this past week and what may happen in the coming week, as we have inflation data and retail sales in the States on tap. Now, before we go into the content proper, let me remind you that this presentation is not an offer to buy or sell any kind of securities, be it FX, CFD, or any kind of margin financial products. And the trading of any kind of margin products do carry risk. To understand your own risk tolerance before you attempt to trade any kind of margin products. And of course, I'll be sharing with you my views of the various markets, and just be aware that those are my views and has got nothing to do with the sponsor of this event, which is IronFX. Talking about IronFX, they have been the sponsor for my weekly webinar for quite some time now. And this is a broker that was established in 2010 with operation in 180 countries, offering more than 500 tradable instruments ranging from FX to spot indices to precious metals to commodities and even shares. So if you are keen to open an account with IronFX, do go and check out their website at www.ironfx.com. Okay, and of course, the content of this presentation has not been vetted by any regulatory body, so just be aware that these are the conditions in which I'll be operating, and if you are not comfortable, you are free to actually exit this presentation as and when you like. Okay, now, first off the bat, I'm going to talk about what's happening in the past week in the term of what the market has been expecting. Finally, on last Saturday, on last Sunday, Trump actually went ahead with the imposition of a 25% tariff on both Canada and Mexico, on top of an additional 10% tariff on China, even on top of what has been already existing prior to Trump's return for the second time. So Canada has actually retaliated by actually also announcing a 25% tariff on some items on their exports into the United States. So this is what the market has been very, very fearful about, because a tit for tat retaliation in terms of tariff is going to be very, very damaging. And as usual, the market has actually been prepared for the worst. So when Canada make the announcement that they are also going to retaliate tit for tat for Donald Trump's 25% tariff on Canada imports into the United States, the market actually went into a tailspin. Okay, but shortly thereafter, within 48 hours of Canada announcements of a retaliatory tariff on the United States, they managed to talk. There is a talk between Donald Trump and the Prime Minister of Canada, Justin Trudeau, and they came to a pause, meaning to say that Canada has agreed to actually beef up their border control in terms of equipment and personnel. And of course, that has been one of the reasons why Trump said that he wanted to impose tariff to basically deal with the issue of illegal crossing at the border in the north, as well as the shipment of fentanyl from Canada, although that amount has been negligible. So whatever the case is, that has been the arrangement for 30 days. U.S. is going to suspend the imposition of the 25% tariff pending further negotiation. The same has been also been achieved with Mexico. In fact, the agreement with Mexico came in hours before the agreement with Canada to actually pause the imposition of this tariff by the United States for 30 days. So we see that has created a condition in which market actually rebounded on that news. Now that we have an agreement to at least pause for 30 days. However, shortly thereafter, Trump actually announced that they are going to go ahead with the 10% additional tariff on China, and the market once again came off. And this can be seen very clearly in crypto markets because they are becoming very sensitive to what's really happening in this tariff trade war between the United States and its trading partners. And the big one has not been announced yet because Trump said it will come for the EU. So right now, everybody is watching for the next move once Donald Trump actually imposed tariff on the EU, and that will be the one that will be damaging. This is coming ahead of a Germany election, which is going to be in 2 weeks' time on February 23rd. I think we have to really focus on that particular date itself going into the weekend of February 23rd, which is a Sunday. We have to make sure that we are watching the move, because if the current chancellor of the Germany, which is Olaf Scholz, loses their election, and if the far right, the ultra far right ADF actually wins the election, there will be serious complication, and the market may not take the result very, very well. So going into the German election on February 23rd, I think we got to be very circumspect and be very, very careful as to holding on to long positions. Okay, this is, I think, instead of looking at Wall Street for sign of problem, we need to look into Europe, because Germany, after all, is the leading economic engine of Europe. And if Germany falls into the ultra-right party hands, a lot of things will change, because that party has been very, very focused on eliminating illegal immigration. They will close the border, and they may not necessarily follow through with sanction on Russia. So if the ADF party actually win the German election, it will have a material impact on the war that's currently happening in Ukraine, between Ukraine and Russia. So do watch out for that event, which is coming up very fast in 2 weeks' time. So again, if Donald Trump's actually announced a tariff on the EU ahead of the election or anywhere near the election, it will have material impact. So this is the key event to watch this particular month. Of course, going into March, we will be having to look at what's really happening on the war front in Ukraine. Okay. So China has actually imposed a limited tariff on the United States. This is a very selective and I think very measured way to actually tell the United States that they are capable of retaliating. I think the fact that during the campaign leading to the November 2024 election in the States, Trump has always harped about the possibility of imposing 60% additional tariff on Chinese import into the United States. And the fact that he only started with 10% 3 weeks ago, and that has been seen to be by the market as a climb down from his rhetoric. But I think Trump is basically telling the also sending out another signal that he's giving China 72 hours to come back with a proposal, feeling which I think he said he is free to increase the amount of tariff on Chinese imports. So China has actually responded, and I think this is a very measured way to actually tell the United States, or in particular President Trump, that China is not without options. Okay, so the Chinese tariff is actually imposed on some of their energy products, in particularly coal and LNG, which is liquefied natural gas. China do not buy a lot of energy products from the United States, with the exception of LNG. Okay, so if China really go ahead and impose a 10%, a 15% levy on the energy products, it may have some kind of impact, but it will not be earth-shaking. Okay, and then of course, China also imposed tariff on some farm equipment and some large engine, sedans coming in from the United States. Again, those are not major imports into China, so it should have very limited impact. The question here is, how will Donald Trump respond to this retaliatory tariff imposed by China? Trump, being Trump, is definitely not going to take this sitting down. I think he will have to respond. And if his response is higher tariff, I think that will put the entire world on notice that going into 2025, it's going to be a very difficult year for the global economy because tariff at a global scale is going to slow down the entire global economy quite significantly. So I think it's going to be a very difficult year going ahead. Okay. So anyway, this is where we stand right now. And now the other major news that have made the headlines is the Department of Government Efficiency, in short, DOGE, okay, in which Elon Musk has been given a free hand to actually find ways to cut costs for the US government. And I think he has actually zeroed in on this department called the USAID, which is supposedly set up in 1961 to actually offer foreign aids. But I think it has now become very clear that it has been used as a slush fund to pursue a lot of other non-aid related programs, and everything is coming out into the open. And I think Elon Musk may have opened up a can of worms. And of course, now there are already action by the Democrats to try to clip his wing and say that this is totally illegal, and we will have to see what happens. But it's definitely something in which I think Elon Musk is trying to gut out the unsavory part of the US administration using USAID as a vehicle to fund a lot of illegal activities which has not been approved by the US Congress. A lot of senators as well and congressmen are saying that they are not aware of what's actually went through. And of course, we also knew that among the items that was supposedly uncovered is a $84 million payment to Chelsea Clinton, which is the daughter of the previous president, President Clinton. And this is raising a lot of question as to how that can actually happen, which is something that they will have to deal with the fallout from this discovery. This is obviously something that we want to watch. And I think Elon Musk's next target is going to be focused on the education department as well as the Pentagon, okay? And this is very dangerous game for Elon Musk. He run the risk of a personal risk to his life because these are definitely major players. And if you move their cheese, okay, be prepared for the backlash, okay? So let's see what happens, whether Elon Musk can actually continue to rate and actually conduct audit on the various government departments, okay? Now, another thing that is very curious was there is this thing called the I think the word is the minimis. Okay. Anyway, in this particular clause here, any item less than $800, below 800 US dollars, can actually be imported into the United States without taxes. Okay. So companies like Temu as well as Shein has actually used the loophole to actually sell a lot of items below the radar. And I think Donald Trump has actually closed that loophole, and he announced through the US Postal Service, the UPS, they're saying that these loopholes will be closed with immediate effect, meaning to say that they will not deliver anything that the Americans public buy from particularly these two websites, Shein and Temu. They will now be subject to taxes. Actually, the initial reaction was USPS saying that they will stop delivery of all these items, which caused a little bit of a mayhem because a lot of people continue to buy from these two online apps from China, which has been very popular over the years. And we can see that there was an about turn 24 hours after they announced that they will stop delivery of all these small packages coming in from China. Now they are saying that they will continue to do that. And then we will see what happens going forward. I think they want to close this gap here, meaning to say that anything that is below $800, they will want to tax those items. The question is how to tax because there is no precedent, and I think it was a bit of a mayhem. Nobody knew what to do with this new instruction coming in from the administration. How big is this in terms of dollar impact? I think as of 2023, there were something like 1.36 billion packages been sent, and that amounts to quite a fair bit of dollars, as you can imagine. So we can see that this will impact the consumer more directly, because this has been a trend for the last few years in which people are going online to buy items which are very, very well priced. Okay, we in Singapore already know that such a service like from Shopee or Lazada has been very, very popular, and I think it's the same thing happening all over the world. And these Chinese are able to export directly in minute sizes into different territories. Okay. Now, as far as economic data is concerned, the first number that came out was in Australia for retail sales. It was a disastrous number. Although the market was expecting even worse, it didn't come in as bad as what the market expected. Market was expecting a negative 0.7% dip in the retail sales month over month for the month of December. The previous month for November 2024 was a healthy 0.7. So this was a reversal of that very good number in November. It came in at negative 0.1. So this again is evident that the Australian economy, as far as retail sales is concerned, is still struggling. Okay, so this has actually caused the Aussie dollars to dip further. The next kit that came out was the manufacturing PMI, which is the purchasing managers index for China. And again, this is the version that's been reported by Caixin. It came in marginally lower than market expectation of 50.5 at 50.1. So it is a borderline case, and okay, I have not updated here. I'm so sorry here. So there's a January number that was missing. Came in at 50.1. Okay, so this number here has suggested, based on the last 3 months from the high in November of 51.5, now is sitting at the borderline case of 50.1. We can see the manufacturing sector in China is basically not doing well. Okay, so this will have negative connotation going in for Chinese equity markets. Then on Monday, we have the inflation numbers coming in from Eurozone. Again, it wasn't pretty. For the month-over-month number, the headline harmonized index of consumer prices, when you refer to the chart on the left, you can see that it is from 0.4 positive to negative 0.3 for the month of January. So in terms of the inflation number, we are beginning to see deflation obviously is happening, and this is no surprise, because we knew that Germany, as the engine of the EU, is hemorrhaging, and prices are backpedaling. While it is good to be seen as a decline in inflation, but I think what we are seeing here is actually a deflation. Okay, and when we look at the core harmonized index of consumer prices for the month of January, month over month, we can see that it is also down from positive 0.5 to a whole percentage point down in the negative territory. So this is very clearly a sign of deflation. Deflation means consumers, companies are not able to charge market price for the products. They have to slash prices, and this will be a negative development, because consumers will hold back consumption if they knew that prices can be had better. They can get better price if they hold off expenditure right now. Okay, so this will have a negative feedback loop, and this is something that we do not want to see in any economy, because deflation is very difficult to defeat, unlike inflation. Okay, so when you look at the year-over-year number, we don't see the numbers affecting just yet, because the month-over-month number definitely is more sensitive, and this is very, very current. And the year-over-year number, the harmonized index consumer prices, if you look on the chart on the right, okay, it came in within expectation at 2.5%. This is a touch higher than the December 2024 number of 2.4%. So this is just, if you look at the chart in the bar, instead of looking at the line on the chart on the right, you can see that same September, this number has been rising. So as far as the year-over-year number, we can still consider, we still continue to see that prices are still climbing. Okay, but on the month-over-month number is obviously showing us a different story. Okay, then when we look at the core harmonized index consumer prices, which is the line on the right on the chart to the right, you can see that it is holding stable at 2.7%. In fact, it has been holding at 2.7% since September of 2024. So that one has no change. It is not sensitive enough. But if you look at a month-over-month number, I think the Europeans will be very, very concerned. Okay. Now, next coming up was the manufacturing PMI for United States, and this, of course, is the number released by the ISM. Okay, ISM, of course, is the Institute of Supply Management, and we can see this is a very good development for the first time since 2022. Okay, we are beginning to see the manufacturing popping up above 50. 50, of course, is the borderline case, which anything above 50 is expansion, anything below 50 is of course contraction. And we can see that this is the first time the number that we see since 2022, that the manufacturing PMI has popped back up above 50. This is definitely a very, very positive development, which led to a rise on Wall Street at the start of the week itself. So this is something that should be celebrated. I think it is a gift to Donald Trump now that manufacturing is showing signs that it is expanding. In fact, it has been expanding since October last year. Okay. Now, this job opening, now this is a concern. When we look at the PMI numbers for manufacturing, which is something to be celebrated, this number that we are seeing in the job openings is a major concern. Now, the previous number was 8.1 million jobs that was available, and now we can see that the December number has shrunk back by 7.6 million. So this is a lower than a market expectation of 8 million jobs. And overall, when we look at this number, it's suggesting it is one of the lower number for the whole of 2024. In fact, when we look at this number, the only month that was worse was in September last year at 7.372 jobs, 7.273 million jobs being created. So this is definitely not a good number, suggesting that the labor market may be losing jobs. And with the Elon Musk trying to cut costs for the federal government by laying off, closing out departments, we will probably see this number go down even further, because the number of jobs opening is not good. And this has nothing to do with the jobs availability. Okay, here is that number of jobs being lost in the federal government eventually will show up in the non-farm payroll. Of course, this month non-farm payroll, this past week non-farm payroll has been relatively healthy. Okay, although the wages are under pressure of rising. Okay, so by and large, you can see that the number of jobs being created in the private sector has not increased by a lot. In fact, it has actually dipped. So this is not a welcome sign going forward as far as the robustness of the US economy is concerned. Okay, now with the expected layoff in federal jobs coming on stream, okay, we already knew that 40,000 federal workers have chose to take up the offer to leave their jobs and be compensated for 8 months. But again, this is something that we want to watch, because I think the target is much, much higher. Okay, and when we consider the past 3 years in which we are beginning to see some irregularity in the non-farm payroll data, we have also seen how much of the jobs being created actually goes into federal jobs, okay, federal government jobs. And this is stuffing the governments with more jobs. And I think this is where Elon Musk is going to come in and say these are not productive workers, and he wants to trim the fat, and that will eventually show up in the non-farm payrolls in the months ahead. Okay, so we will continue to watch this, but based on this job opening is not a positive sign. Okay. Now, New Zealand employment data came in. It was not good, but it wasn't as bad. Okay, for the employment change, you can see that the number of jobs being lost has actually recovered a bit. Okay, from negative 0.5% in Q3 to negative 0.1 in Q4. So again, these measurements of labor data on a quarterly basis is definitely not very helpful, because they are very lagging. okay? Unlike the United States where they release their labor reports month after month, okay? For something like this, it is definitely not sensitive enough, but this is what we have. Unemployment rate in New Zealand is still elevated at 5.1%. So definitely we are beginning to see unemployment rate, which is the chart on the right, has been rising steadily since the first quarter of 2023. So the situation in New Zealand, we are beginning to see a lot of Kiwis moving into Australia to look for job opportunity, okay? And this is definitely a reflection of the difficulties that the Kiwis are definitely facing in New Zealand with unemployment at 5.1% and looks like it is trending higher. I think there'll be more pain ahead, and that means it will have negative connotation as far as the Kiwi dollars is concerned. So Kiwi dollars, like the Aussie dollars, has been on the back foot for quite some time now. I think this trend is likely to continue, okay? Then we have the Caixin Services PMI. Okay, earlier on we saw that the Chinese manufacturing PMI is not doing fantastically well at 50.1, and here the services sector has also struggled. Since December, we have 52.2, which is very, very good. They was expecting a slight improvement on that number, but it came in much lower at 51. Again, this is definitely not a good number compared to the whole of 2024. 51 is only the second worst data set. Okay, so again, when we look into the totality of the PMI for China, both in the manufacturing and the services sector, both are not doing well, although the services sector seems to be doing a touch better than the manufacturing. Again, when we look at these numbers, it's actually quite depressing, and it's very obvious that the Chinese economy is still struggling, okay? So with this in mind, just be aware of the Chinese equity markets. Now, this is the private employment data coming in from ADP, which is the month-over-month change in employment. Now, do understand that this number has always been inaccurate in terms of their survey. So it is a very volatile number, but by and large, we can get a sense of where the US employment is going to be coming in. Okay, based on the January number, it was a very, very good number. And this is something that we seeing a bit of contrast between the job openings that I shared with you earlier on. And as far as ADP is concerned, employment is doing healthy. In fact, based on this number, the US stock market has actually celebrated. You can see 180,000 jobs being created as far as ADP is concerned. But this number is subject to wild revision. So you got to take this number with a pinch of salt, okay? But 183 at face value is definitely a very, very robust number, although it is in contrast, in direct opposite contrast to the job openings that we saw earlier on, okay? So again, this is a number that can move market, but it's not a major number, okay? Then we can see that the ISM also releases not only the manufacturing, which was very, very well. Remember, manufacturing PMI was at 50.9 for the month of January. In services, it has actually dipped. So what the manufacturing sector gained could be at the expense of the services sector. Market was expecting an improvement from the December number of 54.1 at 54.2. It came in at 52.8. So it's a bit of a disappointment, basically canceling out the good vibes provided by the manufacturing PMI. So again, we are beginning to see a bit of a mixed signal here. While manufacturing appears to be doing well, seems to be rebounding, services sector is now stagnating. In fact, it has shrunk, okay, from the number that we saw in December. Trade balance, this is again a disaster number, okay? Australia trade balance, you can see, has shrunk, okay, from $7 billion in November. Now is has dropped down by almost more than almost 2 billion Aussie dollars at 5.09 billion Aussie dollars. So this is way below what the market expected. Again, that caused the Aussie dollars to take a hit, okay? So here we are seeing that by and large, the surprise number for November now has come back to earth. In fact, it was even lower than the month of October at 5.09 compared to October number of 5.57 billion Aussie dollars. So definitely, this is a reflection of the struggle that the Aussie economy is facing right now. Okay. As far as Eurozone is concerned, the retail sales is barely hanging up, but it's definitely an improvement. Okay. previous month was at 1.2%. Now it's at 1.9 within expectation. So is this a sign that the European economy is turning around? Not necessarily, okay? But over the last quarter or so, we can see that this number is a lot better than the last 3 quarters in 2024. So again, worth celebrating. Okay, small victory is going to be celebrated. So that caused a bit of a rebound in Aussie, not in the euro, which we see that has been happening. Later when we go to the chart, there is a little bit of hope that the tentative rebound in the Aussie, in a euro may actually sustain a little bit longer. Okay. Now, this is the key thing. Do watch out for the Bank of England. Bank of England has actually been cutting rates a lot more aggressive than the Federal Reserve. The latest interest rate right now in the UK is 4.5%. So this has come way from 5.25%. So we can see that this is a trend, and the reason why this is the case is because the UK economy is really weak, and we want to watch how the gilt, which is the UK version of the treasury bonds in the UK, is definitely under a lot of pressure, and this could be the straw that break the camel's back, because the UK economy right now is not doing well at all. So instead of looking at Wall Street for signs of global trouble, really I think the entire continent, as far as Europe is concerned, between the major economies in the EU and the UK, okay, is showing signs of for more attention. So do watch out for the move coming in and the data sets coming in from the whole of Europe, including the UK. I think the numbers are not good, and the bond markets are already reacting, and this is not good. Okay. Now the 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 most anticipated data coming in this past week has been a non-farm payroll, and like I say, it is coming with a mixed bag. Okay, non-farm payroll is lower than expected. Okay, when we compare this to the ADP employment change, this is in stark contrast. Okay, it's more in line with the job openings that we saw earlier on. The market was expecting 170,000 jobs. It came in 143,000 jobs. So it was weaker than expected. And when you compare it to December number of 256, it was a lot weaker. Okay. But of course, the last 2 months has also saw revision to the upside. As far as unemployment rate is concerned, that was an area of celebration. It actually dipped lower to 4% from 4.1%. So it's a mixed bag here, okay? But the concern here is not these two numbers. The concern here is the next number that came in, which is the average hourly earnings, okay? Month over month, you can see that the earnings has spiked up to 0.5%, basically at the same rate at the beginning of 2024. So this means wages are climbing, which is good for consumer but bad for corporates, okay? So here we have numbers also picking up when you measure it from year over year. So US companies are definitely facing a lot of headwinds in terms of higher wage components, okay? And this is also clearly seen in the year over year number at 4.1%, where the market was expecting a dip to 3.8% compared to the December number of 3.9%. So overall, since the middle of last year, we can see that the average hourly earnings measured on a year-over-year basis has been climbing from 3.6% to the current 4.1%. And it looks like a trajectory is suggesting that we may be seeing higher wages ahead, okay, which is good in terms of consumers, but is bad for the general economy, okay? Now, Canada also released their labor number. The net change in employment actually was a good number. Market was expecting only 25,000 jobs. It came in at 76,000 jobs. And this is definitely one of the higher number when you look into the last 13 months since. Okay, we can see that 76,000 jobs is definitely a good number. Unemployment rate has also dipped, okay, further up to 6.6% from 6.7. Market was expecting a worse number at 6.8, so it's definitely a good number. 6.8 incidentally was the highest unemployment rate in 2024 for Canada. So again, here this is something that we are watching, but I think Canada, this has not priced in the tariff effect yet. Okay, if after 30 days both Canada and United States cannot come to an agreement, on their tariff, this number is going to spike higher, okay, in terms of unemployment rate. Right, in the coming week, we are going to be focused more on inflation as well. Starting today, we already have the CPI numbers, year-over-year number. Market expecting it to ramp up to 0.4%. So this is a good sign because China has been experiencing deflation. So any pickup in inflation to 0.4% is actually a welcome news. Unfortunately, I wasn't paying attention to this, and this number has already been released. I'll come back to you next week. Okay. So as far as this coming week itself, we have middle of the month, middle of the week, we have US releasing the CPI numbers. Here we have headline CPI numbers month over month for the month of January to dip from 0.4 to 0.3%, and the core CPI numbers month over month to edge up 0.3% from 0.2%. Then the most important number, the headline year-over-year number for CPI for the month of January, there's no estimates. Previously was 2.9%. Likewise, the core CPI numbers year-over-year has no estimates. Previously, it was 3.2%. Then we have Germany releasing their harmonized index of consumer prices year-over-year. Here they expect it to stay constant at 2.8%. UK will be releasing their GDP for Q4. Okay, no estimates, no surprise there. I don't think we can expect a good number. Okay, previously Q3 was 0.0%. The GDP numbers year-over-year expected to only achieve a 0.9%, practically no growth. Okay, then US will be seeing the next set of CPI numbers at a wholesale level when we be seeing the release of the core producer price index year-over-year for the month of January. Previous month was 3.5%. Again, there's no estimates. Then on Friday itself, we have GDP numbers for Q4 for Eurozone, expected to stay stable or rather unchanged at 0% for the last quarter of 2024, and on a year-on-year basis, expect to only achieve 0.9%. Okay, very much the same as in the UK. Then the next last major number to be watching out this coming week will be the retail sales for United States month over month. Again, no estimates. Previously was 0.4%, and the control group is at 0.7%. And then to wrap up the week itself, we had the Michigan Consumer Sentiment Index at, again, no estimates. Previous month was 71.1. Okay, so this is the data we will be expecting in the coming week itself. Okay. Anonymous here have been asked a question: how we relate non-farm payroll number and lower unemployment numbers. Again, these numbers are pretty volatile, especially the non-farm payroll numbers are subject to revision. If previous numbers is any guide, I suspect those numbers has been heavily massaged, in my personal opinion, and the good numbers during the Biden administration is always subject to lower revision in the months after. Okay, so do not be swayed by the headline numbers when we see the non-farm payroll here. Okay, and of course the unemployment rate has dipped back to 4%. Now, I remember the highest it actually traded was released was 4.3%, and it is still elevated at 4%. Okay, even though it has come down. So we have high job creation in non-farm payroll, but we see a dip in the lower unemployment rate, which makes sense. Okay, however, there are times whereby we have very low non-farm payrolls number accompanied by low unemployment rate, okay, which does not make sense. Okay, in this latest release this past Friday, the numbers make sense because when you have higher jobs creation, you will logically expect the non-farm the unemployment rate to dip, okay, which is playing out as what it should. But there are times whereby the numbers cause a bit of confusion, whereby they are not necessarily correlating. Okay, so here we have we have not a disaster number. Although the market was expecting 170,000 jobs, it was not a killer. On balance, it was not a disastrous number. It will be disaster if the number dropped below 100,000. Okay, but here we have 147,000, which is not too bad. Okay, so the market took it in its stride. Okay, 1 month does not make the entire year, so just be aware of it. Okay, so now we will go and look at the chart itself. Of course, I'll be sharing with you the markets from the platform of IronFX. And as usual, I will start off with the Dow Jones. And I want to show you the monthly time frame here. Okay, forget about all this footnote that I put for myself. Okay, we have a high in November, 45,075. There will attempt to actually take, which the market actually went to a higher number. Okay, no, there was no breach here. Let me see. Is there a breach? No, there was no breach here. Okay, so there's no new high being traded. The high was still in November of 2024. Okay, so here the remark here is a reaction high, and expect volatility. We have already passed January, so we still have 3 more weeks to go. Okay, in February, but I think the real volatility will actually kick in March. Okay, the event to watch is not so much on what's happening in the States. I think earlier on I did mention the Germany election on February 23rd. I think from that week onwards, okay, in the last week of February, I think we could see volatility spike, and it carries to me a bit of a negative connotation. I really suspect that the Chancellor Olaf Scholz may actually lose the election. Okay, my concern here is who is going to be the next Chancellor, who is going to be in power, and if the ultra far right is in power, a lot of things is going to change, and they are not going to be pretty. Okay, so if the election in Germany comes out with a new party in power, and this new power is the ultra right, definitely a lot of things will be reversed in terms of policies, and this is going to cause a lot of mayhem. Okay, so when we look at the chart itself, Dow Jones still have not shown any weaknesses. Okay, we have another attempt to take out the all-time high. Okay, we can see here that so far in the weekly time frame, this week has also saw a retest, and it has been rejected by the market. Okay, no new high been traded, and both will try back on back in the last week of January, as well in the first week of February. You can see that the 2 attempts and both will push back. Okay, but I think as far as the Dow is concerned, we are still seeing the attempt to actually break through. Okay, whether that can be done, we will still continue. We will still need to continue to monitor. So far, both attempts to take out the all-time high has been rejected. Okay, so the market actually ends on quite a bit of a negative note on a day over day basis. Now the closing here at 44,308 is the lowest closing for the entire week. Okay, so just keep this in mind. Okay, market attempt twice, couldn't break above. Now it has come under pressure. Will this continue into the coming week itself? I think it will go sideways until possibly leading into a reaction as a result of the Germany election on February 23rd. Okay, so keep that event in mind. Okay, when we look at the S&P 500, again, I want to show you the monthly time frame just to give you some kind of perspective. Again, we can see that the monthly time frame here suggests that there was still very much in line with the Dow Jones. The market is still attempting to take out the high, but unlike the Dow, the January resulted in a new high. January 2025 resulted in an all-time high of 6,127.2. So this month is only 1 week old, so it is not representative enough, but we can see that the market is still trying to take out all-time high. Okay, so if there's going to be a new high being traded, I think there's a very good chance it may come from the S&P 500. Okay, overall the market remains elevated. Okay, we have no negative reaction just yet. Okay, on the weekly basis, this week closed lower than last week. Okay, so that is something that we want to watch. Okay, and we have a marginal low compared to the week before this, and that's also suggesting that there's a little bit of cautiousness in the marketplace. And S&P 500, as we all know, is a very retail oriented index, and most of the retail investors are in the S&P 500 and not in the Dow. Okay, so this attempt to take out the market to a brand new high has been led by retail investors. Not a good sign. okay, because the retail investors are always the last to get into a major trend, okay. So if the Dow do not break into new high, the Dow is the one that we want to watch, because if the Dow represents blue chips and they are the representation of international capital flow, and if Dow Jones break into new high, we know that the entire market sentiment remains very positive. However, if any new high traded in the S&P 500 is not replicated in the Dow, it is a sign of weakness, in my opinion. Okay. So again, when we look at the daily time frame, there was this attempt to take out. Okay, but again on a closing basis, we can see that Friday's closing at 6,027.2 is only a touch higher than Monday's opening closing price. So this is not a very, very strong development here. Okay, so going forward, I think there will be the risk of a pullback, continue to come off. Again, we will have to see what will be the catalyst. So far, the tariff war has been behind us. The only question here is whether Donald Trump is going to respond to China's retaliation in terms of tariff. Okay, if he come out and say, I'm going to up the tariff from 10% to 30%, for example, that will cause a sell-off. Okay. Then when we look at the Nasdaq, I think so far this year, we knew the weakness coming in from Wall Street has been the high flyer, okay? High flyer in terms of the tech stocks. Over the last 2 years, we can see tech stock has been leading the market higher, okay? So we can see this past week itself, this past month, so far February is only 1 week old, so we can't see this as representative as to the monthly flow. We can see that for the month of January, there was no new high. So the high was traded in December. Okay, so the all-time high, the 22,132, is actually traded in December of 2024. So far we are into the second month of 2025. There is no serious attempt to take out. Okay, in fact, when we look into the current earning cycles, most of the companies actually hit target, but there are some that actually not been doing well. Google actually was doing reported a good set of numbers, but their stocks actually went down. So this is indicative of perhaps a sense of overvaluation in tech stocks here. So again, we have to watch. So far, there is no sign the market is going to come down seriously. Okay, it's just holding in holding pattern. Let's take a look at the weekly time frame. So this is the weekly time frame. We can see that the market attempt to take out the January high of 21,744. Okay, it did not quite do it. Okay, but it closed about the same price as the week before. So it is basically quite neutral. I think they are looking for new impetus. Okay, on the daily basis, we can see that the market actually closed a bit lower on Friday. Okay, but it is not much of a change compared to the previous week closing price. Okay, and it's a touch higher than the opening closing price for Monday. Okay, so it end up as a more or less not telling us a lot. All I can see is that the market is hovering within the pattern bordered by 20,500 to 22,130. Okay, so it's a very broad consolidation range. No sign that it was going to come off aggressively, but again, I think the period in which we will be more concerned will be the last week of this month. Okay, so going forward, when we look into Europe, starting off with, let's say, the UK index. Okay, this is the FTSE 100, and I want to see the monthly time frame. Against the flow of data, okay, suggesting the UK economy is struggling. This month we see a brand new high in the FTSE 100. Okay, so far it's not indicative. Last month we have brand new high. This month we have new high. So that must be repeated in other index. So far we can see that the European index seems to be doing a lot better compared to, let's say, Wall Street. Okay, this couple of months we can see that other than S&P 500, there has been no new high in equity index on Wall Street. However, Europe seems to suggest that the prices are still very buoyant. The high traded at 8,767.2 is actually created this week itself. Okay, so again, be very, very concerned if the data set does not match the price action. Okay, here we have the weekly time frame, new high traded, close also higher than the previous week. So again, so far it's not time to sell just yet, because the technical suggests that there is the buyer is still very much in charge. Okay, so going forward, just monitor this European indices, which I will, because I think the problem will come from Europe, not from Wall Street. Okay, so if there's any sign that technically speaking, the chart is showing us that uh, uh, the the longs capitulate, okay, then I think we would seriously consider selling this index rather than the Wall Street index. Okay, here we have the daily time frame. I want to show you the daily time frame over here. Again, there's no sign that there is imminent problem. Okay, Friday did not close on a strong note. It closed as an inside bar. Inside bar, this could be a classic reversal pattern, but we do not know just yet. Okay, so when we have one candle bar here that is longer than the current month, okay, and based on Friday, this is a 2-bar pattern setup. Potentially could be a reversal pattern. Okay, if we have a close seriously below Thursday opening price, that could be the trigger point. Okay, so if we have a close in, let's say tomorrow, okay, on Monday, below the Thursday opening price, that could mean that the market has already triggered a reversal pattern. Okay, but it's too early to say. We have to continue to watch how the market close tomorrow in London. And then we take a look at the German index. This is the German index, the DAX itself. I want to see the monthly. Again, you can see that there's an all-time high being traded. It's a marginal new all-time high traded, and the market is close, have a high of 21,947.8. So this is again going against the grain of weak economic data. Okay, retail sales has done well, but we can see that deflation is definitely a problem in Germany. So if you see the index trading higher on the back of weak economic numbers, it is always very dicey to buy. Okay, just keep a watch out for the technical confirmation. If we get a reversal pattern in the chart, definitely I will go with the chart. Okay, here we have new high, and based on the closing price week over week, we can see that this week we have a marginal higher closing than previous week. Okay, again, it is too early to attempt to sell short. We'll wait for the signal to come in. Currently, the buyers are very much in control. Okay, so there's no sign that anything otherwise is going to happen. On the daily time frame, you can see that there was a new high traded on Friday. In fact, the high for this week has been traded on Friday. It didn't close lower than the Thursday's opening price. However, if we get a close below Thursday opening price, that could be the signal. But again, this is not a classic reversal signal. What I would say that you can see that the closing price, okay, actually pulls back more than about 75% of this bar ahead of it. Okay, based on the structure of these 2 bars here, the fact that Friday closes 75% lower from the height of this bar here, okay, is actually could also be seen as a sign of potential weakness. But we need to have more robust confirmation. So I would not consider this as reversal just yet, but they are a good candidate. So on balance, we are not seeing potential for a reversal pattern in Europe just yet. Okay, I suspect it's going to come on after February 23rd. So just keep your eyes peeled for that. And as far as Asia is concerned, we look into the Nikkei 225. Now, Nikkei has been struggling for quite some time now. Okay, although we can see that the high was 42,484, and that was quite some time ago. That was actually traded when? Traded in July of last year. Okay, so far the market has not shown that it's going to collapse. But this week itself, it closed on a weak note. But it is not damaging based on the technical just yet, because this is the monthly time frame. Okay, like I said, we are only in the first week of trading for the month of February. It's not indicative, but you can see that it is definitely struggling above 40,000. So take a look at the weekly time frame. Here we have more consolidation. But based on the closing price, you can see the week they just passed, the closing price is about the weakest since December of last year. So we are at a 2 months low right now. So this is definitely telling us the Japanese equity market is struggling, okay? Because we have the BOJ, which is the Bank of Japan, sending signal that they are going to hike rates further. Okay, and that being the case because recently the week before last, we saw the Tokyo CPI numbers has actually increased, and that gives them the leeway to actually start to hike interest rates. Okay, any kind of interest rate hike is definitely a negative for equity markets. Okay, so I think by and large the market did attempt to trade high, couldn't hang on to its gain. Now we have 2 consecutive weeks of lower prices, and this week's closing price is the lowest since December. Okay, that is something we have to keep at the back of our head when we consider whether to take a position or not. Okay, so this is the weekly time frame. Let's take a look at the daily time frame. We cannot see a disaster just yet. However, there is a very invincible line here, which I've drawn here, suggesting there is support along this line here, okay? Because the last 3 times the market came close to this line, the market actually bounced. So this week will be very crucial. If the week close below this support line here on it, let's say even on the daily basis, that could be the first sign that the market has actually given up on trying to push the market higher in Japan. Okay, so going forward, I think this week is going to be quite revealing. If on the daily basis we have a single day in which the market closed below this imaginary support line here, that could be a sign that the market is unraveling. Okay, so far this is the signal that we are seeing, but it is not solid in a sense unless we get a definitive closing below this support line here on the daily time frame. Now, the other markets that we want to be concerned is actually the Hong Kong market. Now, Hong Kong market has actually done a relatively good job because when we look at the Hong Kong market, we don't get to see the sub-index, the high tech, the tech index is actually doing very well in Hong Kong. Okay, so this is also spilling over into the Hang Seng Index itself. Okay, but I think the real move is in the tech stocks in Hong Kong. After DeepSeek did their job, did the numbers on OpenAI, I think more and more people are very interested in Chinese tech startup. Okay, and I think that has also seen buyers coming back into Hong Kong through the tech index. Okay, so if you want to monitor this index, you can take a look at the tech index, which can also avail yourself to using TradingView. Okay, so the other platform that you can see the tech index is TradingView. Although those index are not tradable, but it is a good sign as to where the demand is coming in from. Okay, on a month-over-month basis, we are beginning to see that perhaps the Hang Seng has actually done a 3-wave rebound already. You can see it's a classical 3-wave rebound. So if this market actually on a close-to-close basis managed to close above 23,264, that is a very bullish development. That means to say on the whole, the market is still negative. Okay, it's still predominantly bearish. However, this rebound that we see here at 14,600 from way back here, that is, where is the month here? In October of 2022, okay, could develop into a more complex corrective pattern. Okay, we have finished a very classic 3-wave bounce. Okay, and if we get a close above this number at 23,264, that could suggest that we are looking at something different. If this end up as a very long wave, okay, we are beginning to say there's a 1, 2, 1, 2. Okay, if this extended into something very aggressive, okay, very impulsive, it could be something totally different. For all we know, this could be building up to be a 5-wave, for all we know. Okay, but here we have only seen a 3-wave bounce. Okay, followed with internally we have a 1, 2, 1, 2. Okay, and if we develop into a 1, 2, 1, 2, 3, meaning to say we have a very explosive rally in the Hang Seng. Wait for the next pullback to buy. Okay, because the next pullback is definitely going to be taking out this high here at 31,082. Okay, but again, it's still very early. But the good thing is that in the month of January, there was a pin bar here. On a month-to-month basis, we have a pin bar here, which is very bullish on the monthly time frame. This is followed by another strong week, okay, of closing. And if we look into the daily, the weekly time frame, it would suggest that this rally here may have legs. Okay, this is a very strong rally. Okay, followed by another one here. And while this is not a particularly strong reversal here, but on this week itself is a very, very strong closing. I think the market is buying the DeepSeek story. Okay, and that was also followed very, very quickly with Alibaba also releasing their AI model. Okay, their large language model, which is supposedly even better than DeepSeek. Okay, so if you take in the two incidents into consideration, it gives the market a sense that Chinese tech stocks, okay, startup is actually a lot more innovative than those in the States. Okay, so that could actually give the market a good sense of good a good feeling. Okay, so that could actually spill over into more buying into the Hong Kong market itself, largely through the tech stocks. Now, on a technical basis, this is the daily time frame. The daily time frame, this is the line that I'm considering, which I think is going to be a barrier to cross. Okay, 3 times in the past year, we can see that the market, we can see that this is the third time that the market has attempted to actually trade above 21,300. It did trade above, but it couldn't close above. I need to see a definitive close above this 21,310. If the market on a daily basis in Hang Seng managed to cross above this line, it will set a strong momentum going forward. Okay, so far this is again a 1-2 structure, not strong enough, but here is very, very interesting. This is so impulsive. This move here is so impulsive, and this pullback here is so corrective. I suspect that going forward, there will be a real serious challenge of 23,264. Okay, if the market, the first sign of buyers coming back in a very, very big way is a close above 21,310. Okay, so I think going forward in terms of equity markets, the one that's showing real signs of buyer coming back is actually this index here. So you can keep your eyes peeled for the Hong Kong market. All right, now that I've finished the Hong Kong market, I want to take a look at the currencies. As usual, I will start off with the euro. Euro on a month-over-month basis is still climbing. Okay, I would say climbing. It is still trying to find its feet. Okay. Overall, the market is very bearish. I am long-term bearish on the euro. Okay. As you can see, I'm holding on to 2 positions that are long, and I'm trying to get out of this without losing my shirt. I have, if the market can go back above 104, 105.60, I'm out. Okay. That means to say I will scratch my trade with a bit of profit. But by and large, I'm just playing this potential rebound. Okay. But long-term, this market is going to go the way of the dodo bird. Okay, I have always have a very negative view on the major currencies, and I think the dollar is still going to be the major currencies to watch out, because going forward, when you look at the G7 economies, all are not doing well except the United States, and all this tariff war is going to cause a lot of currency to depreciate. Okay, it will also show up in the major currency pairs. Of course, the emerging markets currency is going to suffer the most. Okay, and but when you look at the euro, I think if this market result in a bounce, so far there's no strong signal to say that it's going to end up as a bounce. But what we had was in January we have a doji. The market is unsure which way to go. Okay, so that could actually cause the market to have to stop falling for at least for now. Okay, so we cannot see in the monthly time frame. Perhaps we can get some more information from the weekly time frame. Not a very strong development. The market hit a bottom here. Okay, at a 101.77, and then we have a very strong recovery. Okay, but unfortunately the price went back down again. Okay, so again they may do another attempt. So at the bare minimum, what we could see going forward this week could be just an internal 3-way rally. If that's the case, the market is going to go to 105.60. okay, is exactly where I want to exit my trade. Okay, so I'm betting that this is going to be internally a three-wave rally, okay, at best. So let's see what happens in this coming week itself. The market is generally higher to sell. So just be aware that the long-term trend suggesting the market is weak. So this is the daily time frame. We can see that the market is struggling. The three-wave that I mentioned, if we get a three-wave rally, we will possibly see an equality move to 105.60 thereabout. So if you believe that this is going to be a three-wave bounce, okay, 105.60 is about where it should end, okay, and any break above 106.30 is going to be a totally new pattern. For now, I think at best we're going to get is three-wave rally, okay, and then for those who wants to join the selling, you can consider doing so within this bracket of price between 105.40 to 106.30. Okay, the market is generally still bearish, so this bounce is seen to be a rebound of a very entrenched bear market. Sterling, remember the Bank of England this week itself cut interest rates. Okay, so we can see that this is a month-over-month basis. The sterling has actually found a bottom at 103.60, and this bounce is part of the rebound structure here. It may not hit its ideal height yet, but generally speaking, the UK economy is not doing well, so we are seeing that in the currency play as well. The market peaked at 134.34, okay, in September last year, and it has been falling. So this month so far we have no new low, but last month we have a low here at 121, okay, in the sterling. Taking a look at the weekly time frame, you can see that the bounce here is actually quite strong, okay, but that has been unwind by the Bank of England interest rate cuts, okay, but this is going against the grain. Okay, if this bar here is any indication, the low here must, the opening price here must hold. So if you're going to do a counter trend trade, you may be able to find one, but go down to the lower time frame to look for a counter trend trade, basically to trade the upside rather than the downside. Okay, again, if you are not comfortable doing counter trend trade, then stay away from the market and wait for the market to exhaust itself. So we have a initial rise from 121. Okay, the high trader is 125.50. So we will see whether this will end up into an also a three-wave bound, similar to, let's say, the euro versus the dollar. So if we have a bounce here into 126.70, that could also coincide with the high that I'm looking at in the euro at 105.60. Okay, so if these two pair all struggle within a very deep retracement area, that could be a sign that the market is getting ready to come back down again. Okay, so nothing major is going to happen in the currency markets. Okay, so when we look into the other currency pair, take a look at the dollar versus the yen. Here we have the monthly. Dollar yen appears to be coming off, okay? So this is the monthly time frame. Last month, we have a high at 115.88, okay? Which is not that far away from last year's high at 162, okay? So again, this is on the back that the Bank of Japan has high interest rates. They are looking to high interest rate all the way to 1%. So if that is the momentum, and they have already given us the forward guidance that they are looking to high interest rate further, then that should actually benefit the yen, meaning to say it will be negative for the dollar. So it's quite natural for the dollar yen to come back down. However, this is seen on the backdrop of a very bullish dollar. So here it could be what it may do on a monthly basis. Three-way pattern are very common. So if we have this three-way pattern, we could be looking at for dollar yen to go back to 136.5. Okay, equality level. So where we are right now is 151.40. So if you go down to 136, that is a good few hundred pips drop here, okay, against the dollar. But by and large, this is a very strong bull market for dollar. So this pullback should be seen in light of a corrective pullback, okay, not that the market is turned, okay, but it is basically a pullback. So we can see that if further in the weekly time frame, this week itself, we see quite a bit of a move in the dollar yen rate, okay. At the beginning of the week itself, we have dollar yen opening at 154.70, and it closed at 151.40. So there is quite a bit of a move here. Okay, this week we can see the market move about 400 pips, and it closed on a weak note. This bar here, we can see that was the opening price was back in December, the first week of December. If by the end of this month, price is lower than this one, okay, which is 148.65, I think it confirms that we are beginning to see a three-way pullback, okay, targeting 130, 136, okay. All right, let's move on to another currency pair. Let's take a look at the dollar versus Canadian, okay. Here we are looking at the monthly, and this is a reversal pattern, okay. We have a new high traded in dollar versus Canadian at 147.94, 94. And this end up as a very negative development, okay? Market break new high, close weaker than the previous month opening price. Although this month is not over yet, but if this is the continuation, then definitely we can see the reversal signal in the lower time frame. But this is definitely a bad development for long dollar position. So we are beginning to see, for now, all other major currencies, including the minor currencies, should actually manage to rally, okay, because the dollar seems to be hitting a bit of an air pocket here. And this is very clear in the dollar versus Canadian rate. Weekly time frame, this is definitely a reversal. You can see here, this bar was happening the week before. We have a new high, very strong opening, close at the weakest since mid-December, okay. This is more than 1.5 month price action. In terms of closing price, this is a very, very negative development, suggesting that near term, the dollar will be under profit taking to the downside, okay. So with this in mind, the dollar Canadian seems to be telling us that the path of less resistance suggests that we probably will see lower dollar rates, okay. Yeah, the last 3 days of trading is very, very tame, but I think it probably will accelerate in a week, in the coming days. So if you want to take counter trend trade in a dollar position, dollar Canadian is offering us the most obvious reason to do so. Can we see the same thing in dollar Swiss, for example? Swiss is not a major currency pair as far as I'm concerned. I don't trade dollar Swiss as much, but we are not seeing that very evident yet, okay? It is basically trading water. So there is nothing exciting about dollar Swiss that I would want to take a position, okay? Take a look at the weekly. We can see that it's also struggling near the 92 cents, okay? Again, there is no definitive signs that anything major is going to happen in this currency pair here. Okay, let's move on. From currency, let's take a look at gold. I think this is where we want to be very careful. For those who trade futures, you will understand that the gold market here, there are two major markets. One is actually in London, which is usually used for delivery. People who want to take physical delivery will go to London, and the gold exchange in COMEX, which is in New York, is basically meant for hedging and speculation. Okay, so right now what we are seeing that the spot price based in London is actually lower than the price traded in COMEX, which is in New York. And this spread between the price quoted in London and the price quoted in New York is widening. It suggests that there is a bit of movements in wanting to buy in New York, taking delivery in New York. There is a lot of reports that suggest that this could be a link to the expected tariff. Nobody knows whether Donald Trump is going to impose tariff on gold. But the current news suggests that people are trading ahead of this possible development by taking delivery in New York, which caused the price quoted in New York to be higher than the one in London. Now, I don't buy this story. I think there is fundamental issues with the availability or the inventory in London. Now, the Bank of England actually holds a lot of gold for other central banks. I'm leaning to the hypothesis in which I think the gold is no longer in London. Okay, it may not be as much because a lot of people wants to take delivery, but I think the delivery date has been pushed back for a lot of people who has submitted a request to actually withdraw. So there is possibility something else that's happening in the gold market, and this can lead to a very, very bullish move. Okay, so far we can see that gold market has hit a new all-time high. This is the monthly time frame. $2,886.80 is the all-time high for spot gold. Okay, and this market can go a lot higher. Okay, can go a lot higher. For the market to go to $3,000 per ounce is not beyond the scope. Okay, going forward, I think gold market is telling us the global trading system is a lot more fragile. One of the reasons why gold price go up is not so much of inflation. Okay, if you look at the inflation numbers coming in for G7, we have seen the worst. But gold prices now is reacting to the upside, largely due to the possibility that the global financial system is breaking apart. Okay, we are beginning to see that in the bond market across the world, whether it is U.S. Treasury or British gilt or even German bonds. Okay, so if you can stay out of the bond market, I think the bond market is going to be telling us a totally different story. So watch out the bond markets. If you can avoid not to be involved in bond market, then it would be great. Okay, because I think bond market is telling us that the global economy is not doing well. That's the reason why people are pivoting towards precious metals. Okay, so we are seeing that in the higher time frame. We are also seeing it in the weekly time frame. Okay, very bullish. We can see the closing bar every single week, okay, since the end of 2024. Every single week has been positive. On a closing basis, the prices are basically accelerating to the upside. And then in the daily time frame, I think you can see we have prices going ahead. Okay, and this is interesting. Okay, this on its own can be seen to be a reversal pattern. Okay, because this is a shooting star. Okay, so do watch out how this thing develops. If there's going to be near-term weakness, it all depends. I'm still going to be looking for a level to buy. Okay, I have not got myself back into the gold market for quite some time now. Okay, so I'm always very leery about buying at record high levels because I feel that it will be laying a possible bull trap here. Okay, but by and large, the market is definitely going to go up. Okay, so watch out for levels to buy. Okay, in the meantime, where the market closed this past week is not the best price. Okay, this is a negative development here. So there could be some near-term pullback. Again, where we want to look at will be somewhere around here. Okay, this bracket of prices here. Okay, this is where the market took off again. So if the market comes back into this bracket of prices, which is defined as anything between $2,730 to as high as $2,785, this somewhat $55 range is going to be a catchment area. So if the market can come into this bracket of prices, look for some kind of reversal pattern to the upside. Okay, I definitely won't be buying here. Okay. All right, let's take a look at the silver market. Silver market may be enjoying a little bit of a squeeze going on right now. Okay, so let's take a look at the monthly time frame. This monthly time frame suggests that this trend here is more to the upside than the downside. Of course, it's not as strong as the gold market price action here, but we can see that it is quite buoyant. Okay, silver market is quite buoyant. The near term, if this is a three-wave possibly we see resistance at $36. But so far the high here is $34.85. Okay, nothing to see here in the monthly because it is not trending as much as gold market. But we want to also keep keep our eyes on silver market. It has not dropped a lot. Okay, the most we can expect is maybe a bit of a pullback below $28.70. But by and large, we should also be considering silver, not only necessary on the gold market. Can we see something interesting in the daily time frame? This is not a classic reversal signal. Okay, so yeah, if gold result in a bit of a pullback, then it may also spill over into the silver market. By and large, if we can afford to look for buying opportunities, we should. Okay. Now, when we look at the oil market, this is the WTI. WTI on the basis market is very near a catchment area. Okay. All the talks about Donald Trump going to encourage drilling is going to be offset by the sanction imposed on Russia. Now, Russia is a major oil producer, and if you sanction Russia in terms of not allowing the tankers to actually call the port, okay, to unload, then of course you're taking away a major part of the supply, okay. But if US is going to increase production, which takes time, okay, it should actually lead to lower oil prices, okay. And I think at the end of the day, I think Donald Trump's playbook here is that in order to get Russia to come back to the negotiating table to sue for peace, he wants to hurt the Russian economically by targeting their major export, which is energy products. Okay, so if it resulted in lower energy products, maybe the Russian may be incentivized to come to the negotiating table to end the war. Okay, but I think the Russian have already shown that they are in this war, okay, to get the result that they want, okay, which is a neutral Ukraine, essentially not part of NATO, okay. Unless that can be done, the Russian will not come back to the negotiation table, because anything other than victory, okay, in the eyes of the Russian, is going to be seen as a defeat, okay. So Donald Trump do not hold the Trump card here, okay. I think the Russian do hold a Trump card, and they are already in this war for more than 3 years, and very soon they will be in this war for a 4th year. Will come February 22nd, which is the 4-year anniversary of the war in Ukraine, which is coincide with the day before the German election on February 23rd. I think it's just so coincidental. Okay, I don't think the Russia will capitulate to come to the table to negotiate to do a negotiation. Okay, so by and large, will that result in lower oil prices? It does seem to be the case so far, but technically speaking, there is demand at $64 basis the WTI. $64.08 was the low here that we saw here in May of 2023. And again, the last time we saw anything sub $65 was in September of last year. Okay, the low traded was $64.75. So this could lead to lower prices. Here on in January, we have a shooting star, which is not a good development, suggesting lower prices. And we did get lower prices this week. Okay, the prices closed at $70.83. But by and large, this area, this big blue area, $57.63 all the way down to $72.36 is a buying area. If within this area we get a very strong signal to reverse, okay, on the monthly time frame, what I'm looking for is something like this. This could be something that, if it happens within this bracket of prices highlighted by this blue area, then that will be the signal for me. Okay, if I don't get it on the monthly time frame, I hope to get one in the weekly time frame. So far, I'm not going back in yet. Okay, I exit my long position quite some time ago. Okay, so here we have prices going back into this blue area, which is defined as a very deep retracement level, confined to $57.23 to $72.05. So I can still allow the price to go down. If it drift lower and I get a very positive reversal signal in a perhaps as a hammer, then that will be my cue to go back in again. Okay. In the daily time frame, I don't see the buying signal coming in just yet. Okay, the market is still trading lower. Okay, we have done a three-wave move, not quite ideal. The three-wave move equality price is at $79.68. We have a high of $79.35, so not quite ideal. So if the price do drift lower into this breakout of prices, somewhere between the $66.17 to $68.68, that could be something like this. Okay, this is a two candle bar formation. This is a engulfing bar, bullish engulfing bar. If I see something like this, I'll be looking for level to buy in a lower time frame, perhaps in the 4 hours or 1 hour time frame. Okay, so this area is definitely a catchment area. All right, now we have finished with the commodities. Let's take a look at Bitcoin. And we all knew Bitcoin has been very volatile, and it has actually rose on the back of Trump's victory. Okay, so this November move here, okay, was that Trump victory in the election. Okay, and the market subsequently went into new high last month. New high was $109 and $109,567. That was the new high. So far this month, the market is a little bit sluggish, no follow-through buying. Okay, so from the higher time frame, like the monthly time frame, this market is very, very bullish. Okay, and I just read report that the Trump media has actually registered some pattern, something like 6 or 7 pattern, and they're going to launch crypto product managed account for crypto products going forward. Okay, so this could be a positive development. This news came in just hours ago. That I remember in the day before his inauguration on January the 20th, Trump actually issued a meme coin called a Trump coin. The Melania coin was also launched on the same day, but Trump coin uh, was the news. Okay, and of course we have seen prices pulling back from this high, but the new development, because Trump is a brand, okay, people do buy those coins. Okay, so if the Trump media company, which is closely related to Trump himself, is going to launch any kind of financial products in this particular digital asset space, it will draw buyers into the marketplace, and this could be another catalyst for the next leg higher. Okay, so in the meantime, the market is struggling. We will have to see prices is back below 100,000. So we can see this past month, this past week itself, the Bitcoin itself has gone back to test the 91,000. So this can be seen clearly in the weekly time frame. We can see that the market traded a high of 109,567, pull back, and as we are right now, the market is about 96,000. Not much change from yesterday prices. So we can see there's a bit of a consolidation going on. Okay. Can we see something better in the daily time frame? Maybe. Okay, by and large, I am going to be a buyer. Okay, the price do come back into reasonable level. So right now we're in a bit of a corrective pattern. Okay, so we want to see lower prices, and if the market can go down to 81,000 to 85,000, that could be the catchment area to look out for. Okay, right. What about the other coins? Okay, it seems that Ethereum seems to be moving this past week. Okay, this is the Ethereum price chart, not as bullish looking as the one that we saw in Bitcoin. Okay, after all, this is the largest altcoin. Okay, other than Bitcoin. So this suggests that we probably will see lower prices going ahead. So far, the bottom is at 2,100. Could we test this level? We have already tested this level. The low traded this week itself is at 2,136. Okay, suggests that we could be in a bit of a consolidation. Okay, are we seeing that happening in the weekly? Weekly, we have a bit of a bounce, but this bounce is still too early to say that this bounce will be sustainable. But if it can close higher by the end of tonight, then it will set a stage for a strong rally. Okay, so right now, this level where it is currently trading at 2,643, it's not a very strong closing, but if it can go up, let's say to 2,770, for example, that will create a classical reversal signal. We have a few more hours to go before the market closes for this week. Okay, so it all depends on how it closes by the end of today. And if you take a look at the daily time frame, we already have a reversal signal. Now this happens on Monday. Okay, February the 3rd. Okay, we have this move here, which is a classical pin bar. Okay, and this is a hammer, very, very strong development. So how do you trade this? Usually what I'll do is I'll take the height of this initial move here. Let me expand this chart to make it bigger for you. So the low is at 2,136. The high is at 2,940 thereabout. So anywhere about 50%. Okay, $2,535. Okay, so the market now is struggling kind of low. If price reacts to the upside and end up as a reversal pattern, that is a signal the market has found a bottom, because this is the initial signal. Okay, market pulls back 50%, end up with another reversal signal on the daily time frame. I think that is as clear cut to get back in on the long side. Okay, so I'll be looking for developments here, anywhere for a reaction around $2,536 in Ethereum. Now, the one that actually has a most reaction is actually Ripple. Now, Ripple, unfortunately, was hampered by stoppages. For some reason, trading in Ripple was actually suspended more than one time, okay, on major exchanges. And this is very, very rare. So we have a high here at $3.40 just last month. And this month we have gone back to as low as $2. Now, last week I remember telling you guys $2 will be a very, very good price to buy. Okay, and the price came back even lower than $2. So this is the weekly time frame. Very positive development. Okay, so this is how it looks like right now. This can be seen to be a reversal pattern on the weekly time frame, provided it doesn't close back lower. Okay, if it can close higher, ideally above $2.58, that would be even better. Turning this candle bar here from black to white, then that would be a very positive development. But if that is not the case, the market ends about here, that can be seen to be a somewhat reversal pattern as well. But I think the answer will come in the daily time frame. Like Ethereum, this is a much stronger development. Okay, this bar here that we see here, it's a very positive development. Okay, this is on February the 3rd. Okay, so we can see that this is the classical reversal. Now, how do you do that? You take the 50% mark as well. Okay, you see how the price is being supported at the 50% mark after doing the initial reversal. This pullback is where we should be looking for a level to buy. The level is $2.28. So far, there is no classical reversal when the market hit this level. Okay, so if we end up in a textbook example, we have a reversal pattern happening in the next few days in the form of something like this or like this. Okay, then it is a buy. Okay, so prices has overshot this resistance and support line, but on a close to close basis, it has not. Okay, so if I show you the closing price, so if this is the closing price, let me change the color here so you can see the color better. So you can see this black line here is the closing price. On the close to close basis, the market has not hit this line yet. So if the market can drift lower, ideally we get a reaction at the $2.28. The other area to look out for will be the 61.8%. So the other level to look out for, anywhere between $2.16 to $2.28, is definitely an area of interest for me. Okay. So there I have it. I'm going to conclude my session. If you got any question for me, I will take your questions. If not, then I will end the session. Any question for me? It seems that you have no question for me, and I thank you for your time, and I'll see you next Sunday. Bye-bye. Take care.